model used in the reality. Okay, so in last class we reviewed the dividend discount model, especially constant dividend discount model. So in dividend discount model, we can calculate the intrinsic value of the company by using only dividend. Okay, but it's very hard to forecast the dividend on each year directly, or it's very impossible. It's really impossible to anticipate the dividend accurately. So instead of the just normal dividend discount model, we can use the dividend growth model, constant dividend discount model. So we assume that dividend grow at a constant rate. Okay. So so we can figure out the intrinsic value by using dividend discount model is the D1 divided by RS minus G. Right? So if we assume that dividend grow at a constant rate, then we can drive this equation, okay, so by using the sum of infinity geometric series, right? So only if this is three kinds of variables, right? So for a dividend that we will receive the next year, and the required rate of return from the point of the investor, or the cost of capital, cost of equity from the point of a company, then the growth rate, dividend growth rate. So if we oops. So if we know these three kind of variables value, dividend that we will receive the next year, required rate of return, and the growth rate, dividend growth rate, the growth rate, then we can calculate the intrinsic value, right? So dividend that we will receive next year is normally given information. And the RS, we can figure out the RS, we can calculate the RS, required rate of return, by using SML, security market line, right? 어디 갔어? Where's Virginia and logged out? Disconnected? 어디 갔어? 들어오겠지? Okay. So, and the G, so we can calculate the required rate of return by using SML, security market line, as you study already. And the growth rate, dividend growth rate, can be calculated by ROE times B. So as I told you, ROE decide the size of pie, right? And, from the generation of the the profit pie, profit or earnings pie that the company generate. Okay, so the ROE decide the size of profit, and B decide, this B means the plowback ratio or retention ratio. So some part of the earnings can be paid out to the shareholders. This is called as dividend, right? Remaining part of the profit can be retained to reinvest in the future. This is the plowback ratio, right? So the growth rate, dividend growth rate, can be calculated by ROE times plowback ratio or retention ratio. Or this equation can be expressed by also ROE times 1 minus B. 1 minus B means dividend payout ratio. Right? So 1 minus B is a dividend, no, ROE times B, or, no, not that one. 1 minus B is dividend payout ratio, right? 1 minus B is dividend payout ratio. So ROE times B, or ROE times 1 minus dividend payout ratio, right? Dividend payout ratio, 1 minus dividend payout ratio times ROE equal ROE times B. Okay, that's the growth rate. So we can use this equation if you know the three value of the three variables. So that we talked about constant dividend discount model in last class. Then what if zero growth stock? So if dividend is expected to remain constant over time, then how can we calculate the intrinsic value? So we assume that if we assume that dividend grow at a constant rate, then we drove the equation to calculate the intrinsic value of the company, P0 equal to D1 divided by RS minus G. Okay, based on this equation, what if G equal to 0? G equal to 0 means growth rate is 0, dividend growth rate is 0. Then G equal to 0, then remaining one is D1 divided by RS, right? D1 divided by RS means in this equation, we assume that the dividend do not grow, which means dividend is always constant, right? So D1 dividend equal to D0 equal to D2 equal to D3 equal to D infinity, right? So if dividend is fixed, the amount of dividend is fixed, then the amount, the dividend that I already received in last year is equal to dividend that I will receive next year, equal to dividend that I will receive the 2 years later on. So if dividend do not grow, then those kind of stock can be calculated by using this simple equation. Okay, so dividend is expected to remain constant over time. Then we can calculate the intrinsic value of those kind of stock by using this equation. So this equation then can be used to estimate the intrinsic value of preferred stock, because preferred stock dividend for preferred stock is fixed. Okay? It's not necessarily that all of the preferred stock dividend is the fixed, but generally normal preferred stock dividend is fixed, constant, right? That is the one factor to describe the characteristic of preferred stock. Okay, so that's why this equation now can be used to estimate the intrinsic value of preferred stock. It's not necessarily, but though. So why? In reality, there are lots of the provision attached to normal preferred stock. For instance, there's some type of participated preferred stock. In participated preferred stock, that is the even if there is the preferred stock, but if the participation provision attached to the preferred stock, then the dividend is more likely to change, not fixed, not constant. Okay, participated means even if the preferred stockholders can participate in the sharing of the profit. Okay, so as you know, dividend for the common stockholder is always changed. okay, depending on the performance of the company. So if the company achieved a very good performance, then the dividend will be increased. Okay, but the performance of the company is very bad, then it's okay not to provide a dividend to the common stockholders. It's okay. Okay. But in terms of from the point of the preferred stockholder, okay, preferred stockholder, uh, it is nearly necessary to give the dividend, fixed dividend to the preferred stockholders, uh, uh, regardless of the performance of the company. Okay, but if the provision of participation is attached to the preferred stock, then the preferred stockholders also ask the give me the more dividend. Give me the more dividend if the company's performance is good. Okay, so 또 커넥션이 안 좋네. Bad for connection situation. Okay, so this is the normal this equation. This equation can be used to estimate the intrinsic value of preferred stock. Okay. All right. So here's the example. If risk-free rate is 7%, market return is 12%, beta is 1.2. Then what is the required rate of return on the firm stock? So you can use the SML. Security market line, SML. So you're familiar with this equation, right? That is very real. So the RS equal to RF plus, you're familiar with this equation, right? So the risk-free rate is 7%, market risk premium is 5%, the beta is 1.2. And so if we use this equation for SML, then the required rate of return is 13%. Okay, required rate of return is 13%. So that this is required rate of return from the point of investor, and the cost of equity from the point of the company, right? That is identical features, but a different name depending on the perspective. Okay, so this is required rate of return from the point of the investor, cost of equity from the point of the company. Anyway, we figured out the required rate of return in this example of 13%. Okay. Then what is stock's intrinsic value? If the dividend is $2, dividend that I already received, $2, or dividend that I received today is $2, and growth rate 6%, constant 6%. Using the constant growth model, then D1 equal to B0 times 1 plus G, because we assume that dividend grow at a constant rate, and growth rate is already given. The information of growth rate is already given. So the dividend at time 0 is $2, and growth rate is 6%. So $2 times 1.06 is going to be $2.12. So I will receive dividend that I will receive the next period is $2.12. growth rate, I mean the required rate of return is already we figured out, plus 13%. Growth rate is 6%. So if we solve this equation, intrinsic value of the stock is $30.29. Okay, $30.29. So most of you guys are confused. The time, the 0, 1, or something like that. The exact one is so 0, 1, 2, blah, blah, blah. So we are here, right? We are here. So this is D0, P0. This is D1, P1. So basically, we assume that we are at the end of each period. At the end of each period, we assume that we are at the end of each period. So D0 means what? Dividend that I receive today, right? And we can calculate the intrinsic value of stock today, right? That's the most exact explanation, right? But it's not necessarily, because why? For example, this is October 10th, October, not 10th, October 26th. So we are here now, October 26th, in the midst, three-fourth out of the total calendar year, right? Three-fourth of our calendar. We are here now, right? Then if we use this D0, then it's a little bit, the different, right? So because the P0 is here, P0 is not the December 31st, 2020, right? We are here now, okay? So there's some time gap. So it's very complicated. So in the both the example and the exam, we basically conjecture we are at the end of each period, right? To simplify the assumption, we are at the end of each period. That's going to be simple, right? Then how can we solve these kind of things in reality then? So for example, this is the October 30, for example. Then the reality, we should consider the time that has passed in pro rata base. Okay, so for example, this is D0. D0 means the dividend that we already received at the end of last year, right? Because most of the company that provide a dividend once a year, but it's not necessarily as well. So some companies provide a dividend twice a year, but generally company provide a dividend once a year. Okay, so D0 in this example, in that case, D0 is the, if we are here October 31st, 2021, but D0 means what? The dividend that we already received December 31st, 2020. There's a very time gap, right? Then how can you calculate that one? So if we calculate when we calculate the dividend, then dividend D1 divided by 1 plus RS, D2 divided by 1 plus RS square, D3 divided by 1 plus RS to the power of 3, something like that, right? The exponent 1 means 1 year, 2 years, 3 years, right? So we need to use this duration to calculate the discount rate, right? Discount rate. So in more exact way, if we are here October 31st, then P0 can be calculated by what? D1 divided by 1 plus RS not 1. D1 divided by 1 plus RS, what? RS, this is this amount, this duration should be considered as discount rate, right? This amount, this is 2 months. So out of 1 year, 10 months has already passed, right? So to calculate the present value as of today, which means when the October 31st, then the exponent not 1 but what? 0.2, right? Not 0.2, 2 divided by 12. 2 divided by 12 because the 10 months is already given, already passed. So only 2 months are remaining until at the end of 2021. So this dividend that we will receive at the end of 2021 should be discounted by not 2021, not 1 plus RS, but dividend 2021 divided by 1 plus RS, remaining one, 2 divided by 12, right? That's the more that's the more exact calculation, okay? But looks like very complicated, right? So in the exam as well as in the example, we assume that we are in the at the end of each period, at the end of each period, not that here, at the end of each period, at the end of each period, at the end of each period. So you need to know how can we calculate the intrinsic value. When we calculate the intrinsic value, how can we use the discount rate to get the present value? So I explained those kind of things. All right, but never mind, because the in the exam as well as in example, we conjecture we are in the at the end of each period, right? So that I explained the more correct way to calculate the intrinsic value. So we figured out the price intrinsic value, the zero P0 is a $30.29. And what is the expected market price of the stock 1 year from now? So D1 will have been paid out already. So P1 is the present value as of year 1 of D2, D3, D4. So we already figure out P0 is D1 divided by RS minus G. So P1, so we can shift our the point from 0 to 1, then definitely D1 is going to be D2 RS minus G, right? Then how can we calculate D2? D2 calculated by D1 times 1 plus G equal to D0 times 1 plus G square. So we already, I gave you the information of the dividend as of today, at T equal to 0, $2, and growth rate is 6%. So 2 times 1.06 square is going to be $2.247. Okay, so intrinsic value, stock price 1 year later is expected to be $32.1. Okay, also could also find the expected P1 equal to P0 times 1 plus G. Okay, is $32.10. Okay, so the same thing, right? Either way, if we use the dividend discount model or if we use just the multiplication by the growth rate, dividend growth rate, the result is same thing. Or we can drive this equation in another way. So P1 equal to T D2 divided by P0, P1 equal to D2 divided by RS minus G, right? So D2 equal to D1 divided by 1 plus G times 1 plus G divided by RS minus G. What is this? D1 divided by RS minus G. What's that? 준서. D1 divided by RS minus G equal to
P0?
P0, right? So P0. So that's why P1 equal to P0 times 1 plus G. If dividend grow at a constant rate, right? This one, right? So if we assume that the dividend grow at a constant rate, then stock price is also grow by using dividend growth rate. Okay, this can be worked out only if dividend grow at a constant rate, right? Okay, so in this example, what are the expected dividend yield? So as I told, don't be confused about dividend yield and dividend payout ratio. Dividend payout ratio. So I told you, don't be confused of dividend yield and dividend payout ratio. Dividend payout ratio is a portion of dividend out of total profit. Dividend yield is the return. So D1 divided by P0 is the dividend yield, right? So what are the expected dividend yield, capital gain yield, and total return during the first year? So total return can be decomposed into dividend capital gain yield plus dividend yield, right? So total return can be decomposed into capital gain yield and the dividend yield. So as you know, capital gain yield means what? If you buy some stock at $20 and if you sell this stock $22 up to $2, then what is the return? In that return is capital gain yield. So we would say, oh, I make some the capital gain, right? I make some the capital gain. So how can you calculate the capital gain yield in this example? 22 minus 20 divided by 20. This is the 10%. Okay. So if you buy some stock at $20 and sell that stock at $22, then capital gain yield is 10%. In addition, if you hold this stock for 1 year, for example, then during the holding the period, if you receive the dividend, okay, then you can enjoy the additional return, which is called as dividend yield. Okay, so total return is dividend yield plus capital gain yield. So if you hold the stock, you can enjoy two resources to get the return. Two resources. Well, one of them is capital gain, the other one is dividend, right? So we already figured out total rate of return. Required return is 13%, right? So 13% can be decomposed into two parts. Capital gain, which is the 6%, and the dividend is 7%. Okay, so dividend yield is the current stock price is $30.29, and the dividend is dividend that we will receive next year is $2.12 because 1.2 times 1.06 is going to be 2.12. So dividend yield in this example is the 7%. Capital gain yield is P1 divided by P0 by P1 minus P0 divided by P0. So P0 already we calculated P0 as well as P1. So P1 is $32.1. P0 is $30.29. So capital gain is 6%. So total return equal to required rate of return. Required rate of return can be decomposed 13% can be decomposed into dividend yield and capital gain yield 7% and 6%. So see 6% is what? Growth rate, dividend growth rate, right? So if dividend grow at a constant rate, then capital gain yield is equal to dividend growth rate. Okay, let me see again. If the dividend grow at a constant rate, then the capital gain yield is same as dividend growth rate, right? So as 13%, right? So, and what if growth is zero? Dividend growth rate is zero. So the way to calculate the intrinsic value of the preferred stock, as I told you. So what would the expected price today be if growth rate is zero, right? Then we assume that dividend at t equal to 0 is $2. Okay. So if the dividend do not grow, then D0 equal to D1, D1 equal to D2, D2 equal to D3, right? Always $2. Then, this is the again geometric infinity series, right? So the D1, D0 minus D0 divided by RS, D1 divided by RS minus G equal to 0, then D1 divided by RS, D1 equal to D0, right? So $2 divided by 13% is gonna be $15.38, $15.38, right? So if we compare dividend grow at a constant rate at 6%, that in that case the stock price is $30.29, right? $30.29. But if dividend do not grow, then the stock price is $15.38. This is sort of the way to calculate the intrinsic value of preferred stock. So if we compare this stock price and with this stock price, then it's double. It's almost double, right? So it's almost double. So this is the common stock value. This is the preferred stock value, you'd say. So in reality, common stock, preferred stock value is not necessarily, but generally preferred stock is 70% of value with respect to common stock. Okay, common stock value. So for example, Hyundai Motors. So if the Hyundai Motors common stock price of Hyundai Motors is $100, for example, no. Right, $100, for example, then the Hyundai Motors preferred stock is $70. Generally, 70%, we'll say. So because there's no growth of the dividend, in reality, we'll say the preferred stock price is the 70%, 0.7 of common stock price, we would say, because the error, right? Due to this procedure. All right, so far we talked about the dividend discount model, constant dividend discount model. We assume that the dividend grow at a constant rate, all right? But when we started this chapter, I told you dividend discount model is the unpopular, right? Especially constant dividend discount model is the more unpopular because how dividend grow at a constant rate, how the dividend grow at a same growth rate on every year is impossible. Right? So to loosen those kind of our assumption, we will talk about supernormal growth or non-constant growth model. Supernormal or non-constant growth model. So if we take a look at the growth of the firm company's life cycle, then we would say companies, if we reflect the company's life cycle, company grow just like this, something like that, this line, right? S line. So at the startup stage, we do not know that company grow rapidly or bankrupt, right? We do not know. But after passing the threshold point, then the dividend grow very fast, right? This is the total, the firm's life cycle. And also, if the life of the company pass the threshold point, then the growth rate is very marginal. Okay, so we just say company grow very fast at the earlier stage, and as the middle stage and the in the last stage, the company's growth rate is very marginal. Okay, so we would say, but if we use the constant dividend discount model, then this line is not curved, but what? Linear. If the company's growth rate over the life cycle is linear, then we can use the constant dividend discount model. But in reality, how the company grow and the linear same rate, right? So in reality, the company grow just like this curve S line, right? So at the earlier stage, company grow more, right? Rather than other stage. Okay, so if we consider those kind of things, then now we changed our assumption is what? The part of the firm's life cycle in which it grows much faster than the economy, or much faster the average growth rate over the entire life cycle, right? And at the earlier stage, then we can forecast the dividend in the near future till time n. Okay, so we can forecast the dividend directly until the time n, and this dividend growth rate is the huge rather than latter part, right? And then we now just same as the constant dividend discount model, and then we assume that dividend grow at a constant rate after year n. Okay, so just we can shift the time that dividend grow at a constant rate from 0 to n. Okay, we can shift the time that they grow at a constant rate from 0 to time n. And within the time 0 to n, we can calculate that we can forecast the dividend directly, which are which have the higher growth rate rather than latter part. Okay, so we can calculate the PN. PN is what? All of the dividend after year N is the as of N time N, right? So these kind of things, can be calculated by PN. These kind of things can be converted to the PN. Okay, so PN means what? The total amount that we will receive the dividend after year N. That's PN. So PN can be calculated by what? PN plus 1 divided by RS minus G. That's it. So just what? We move our the time from 0 to N. And then the dividend grow at a constant rate after year N. Then Pn equal to Pn plus 1 divided by Rs minus G. Just shift our perspective from 0 to N, right? The shift, right? So, and this Pn, which is the sum of all the dividend that we will receive after n plus 1 and after n, should be discounted by 1 plus rs to the power of n, because this Pn is value as of n, not 0. So we need to calculate the present value of this Pn as of 0, right? So this Pn should be discounted by 1 plus rs to the power of n. Okay, so that's it. All right. So there's some the terminology. So we would say this is the PN means the horizon value or continuing value. PN is called as horizon value, continuing value, terminal value. So horizon value, continuing value, or terminal value can be defined as the value at the horizon date of all dividends expected thereafter. Right? The horizon value can be defined as the value at the horizon date of all dividends expected thereafter. Then what is the horizon date? Horizon date or terminal date is the date when the growth rate becomes constant. At this date, it is no longer necessary to forecast the individual dividends. So before horizon date, in this example, N, we need to forecast the dividend directly. But after horizon date, we don't have to forecast the dividend at each year, because we assume that dividend grow at a constant rate after year N. This is horizon date. So in this example, horizon date is N, right? Horizon date, terminal date. And the terminal value or horizon value, continuing value, is all of the, all of the value that we will receive the dividend after horizon date, in this example, N, right? So this is the, present value of dividend during the non-constant growth period. Dividend, present value of dividend during the non-constant growth period. This one is the present value of horizon value. So if you take a look at the page number 378, figure 10.3 illustrate the dividend growth rate. So x-axis is the years, y-axis is the dividend. So as you can see in the blue graph, so until the year 3, the dividend grow very fast, because we assume that the the growth rate of startup company is rapid. So until the year 3 in the figure 10.3, the blue line is very steep. Okay, but after year 3, that's the very, getting the flat, right? So because the growth rate is gonna be, lower. Okay, so we 재택근무 종료 안내. We may anticipate the dividend directly within the terminal date, or we also assume that during this period, dividend grows some rate. Definitely, dividend during this period is higher than dividend growth rate in the second part, right? So first part, earlier part of the dividend is higher than the dividend in the latter part. Okay, so here's the example. If growth rate is 30%, wow, huge growth rate for 3 years before achieving long run growth of 6%. So in this example, we may anticipate the dividend at 1, at 2, at 3, but in this example, growth rate is always, the constant during the year 3, until the year 3, which is very high growth rate, 30%, 30%, 30%. After that, we anticipate the dividend grow at a constant rate of 6%, right? So during the 0 to year 3, we assume that the dividend grow 30%, but after year 3, from year 3 to forever, growth rate is 6%. Okay. Then, first of all, we need to calculate the terminal value, continuing value, horizon value. So P3 include all of the dividend that we will receive after year 3, as of year 3, right? As of year 3. So P3 can be calculated by P4 divided by RS minus G. P4 is the $4.658. How can we get the $4.6658? Because the dividend at time 0 to $2 is 30% increase, right? So 2.6 can be calculated by 2 times 1.3. 3.3 is 2 times 1.3 square, right? How can you get 2 times 1.3 to the power of 3? 2 times 1.3 to the power of 4, right? It's 4 point. So P3 equal to D4 divided by RS minus G. D4 is the $4.658, and the required return is already we calculated, right? 13%. And growth rate after year 3, constant growth rate is assumed to be 6%. Constant growth rate is 6%. Okay. So if we calculate the P3 terminal value is $66.54. So terminal value in this example is the $66.54, which means what? All of the dividend that we will receive after year 3 is $66.54 as of year 3. Okay. Now, what's the next step? Now we should calculate present value now, right? We are here now, not there, but here. So all of the dividend stream should be discounted by 1.3, right? 1.3 to get the present value of today, right? So $2.301 can be calculated by 2.6 divided by 1.3, right? How can you get this one? $3.38 divided by 1 plus 0.3. No, not 1.3, 1.3, right? The required rate of return is 13%. So 2.6 divided by 1.13. This one is what? 3.38 divided by 1.13 square. How can you get that one? 4.394 divided by 1.13 to the power of 3. And this $646.114 is the 66.54 divided by 1.13 to the power of 3 or 4, to the power of 3. So be careful, to get the present value, terminal value should be discounted by 3, the 3 of exponent, not 4, because this value 66.54 is calculated as of year 3, not 4, okay, year 3. So 66.54 should be discounted by 1 plus RS the power of 3, not 4, okay? But some of you guys are confused. So many of you guys discounted by, I mean the 4 used as the exponent of 4, right? So not 4 but 3. So be careful. It's not 4 but 3. And then if we sum up all this, the value, all of this value, that's gonna be $54.107. Okay, so if dividend grow 30% until the year 3, after that dividend grow at a constant rate forever as at 6%, then the stock price should be $54.107. Okay, so definitely, if we assume that dividend grow at a constant rate of 6%, then the stock price was 30 point something, right? 30.29. But the dividend grow more in near future, then the stock price goes up to the about 54. It's around 54, right? It's almost double. Okay, so the stock price is changed to the $54.107. So why this name is supernormal? Because this, in the near future's growth rate is higher than the later future growth rate. Okay, so that we will say this period is supernormal growth. So we'll say this is supernormal, the model, right? Supernormal model. Okay, so this is just, that's it. I mean, this is just only you can think about terminal value, the time to calculate the terminal value, not as of today, but as of year 3. That's it, right? It's very simple, not complicated one, okay? Then what if in this case, if we calculate the expected dividend and capital gain yield during the first and fourth year, then it's gonna be a little bit different, right? Different. So so let's think about the capital gain yield and dividend yield during this period, right? Capital gain yield, dividend yield, and we can calculate the capital gain yield and dividend yield at this period, from year 3 to 4. Okay, so let's take a look. Let's calculate the capital gain yield and dividend yield from 0 to 1 year, and then we can calculate the capital gain yield and dividend yield from year 3 to 4. right? Then this is for first year and fourth year. So the dividend yield in the supernormal period, dividend yield is we already figured out the stock price is $54.11. Okay, $54.11. And the dividend is $2.6. Dividend at the year one is $2.6. Okay, so dividend yield is 4.81%. Okay, 4.81%. Then what's the capital gain yield? Capital gain yield is the backward, right? Backward method is because the required rate of return is 13%. Required return, as I told you, can be decomposed into dividend yield and capital gain yield. So once we calculate the dividend yield as 4.81%, then definitely capital gain yield is going to be 8.19%. Right? So 13 minus 4.81 equal to 8.19%. All right? Or we calculate the capital gain yield directly. So capital gain yield is P2 divided by P1 P2 divided by P1 P2 minus P1 minus P0, right? P1 minus P0 P1 minus P0 divided by P0 is the capital gain yield, right? So we already calculated P1 is $54.11. $54.11. We already figured out $54.11. How can we get the P1? P1 equal to what? P2 divided by 1 plus RS. Don't be confused of this. The one is the exponent. Focus on the exponent. Exponent is not 2 but 1 because we are at the end of first year, not 0, right? D3 divided by 1 plus RS squared. This is n minus 1 plus the same thing, right? P3 divided by 1 plus RS to the square, right? So we already know what is the D2. D2 is $3.38 divided by 1.13. And what's D3? D3 is $4.394 divided by 1.13 square. And what is the P3? 66.54. We already we figured out, right? 56.54 divided by 1.13 square. So don't be confused of the exponent in the denominator, not 233, but 122. Okay. So if we calculate this one, then the P1 is gonna be the P1 is gonna be $58.54, right? So $58.54. So 58.54 minus 54.11 divided by 54.11 is gonna be 8.19%. So, that's gonna be 4.658. I mean yeah. So this is capital gain yield is 8.19%, right? So we can solve this equation in either way, right? So by 8.19%. Just it's okay to the capital gain on the total return required return minus dividend yield, or we can calculate the capital gain yield directly. Okay, so as you can see, during non-constant growth period, dividend yield and capital gain yield are not constant, and the capital gain yield is not equal to growth rate. Growth rate, the short-term growth rate is 30%, right? Long-term growth rate is 6%. So it's not equal to 30%, it's not equal to 6%, right? So that's the specific yield, capital gain yield as a 8.19%, okay? So if dividend do not grow at a constant rate, then capital gain yield is not equal to dividend growth rate. But whereas, let's take a look at the fourth year's dividend yield and capital gain yield. Okay, fourth year, we figured out the first year the dividend yield and the capital gain yield. Now let's calculate the fourth year's the dividend yield and capital gain yield. Then dividend yield is 7%, not 4.81%. Capital gain yield is 6%. So how come? So the dividend yield is what? Dividend yield is at times 3, t equal 3. Dividend yield is what? T4 divided by P3, right? This is a dividend yield, right? So D1 divided by P0 is dividend yield at time 1, just like time 1. At time 3, the dividend yield can be calculated by D4 divided by P3. So D4 is $4.658 according to the graph, and the P3 is $66.54. It's gonna be 7%. Okay, so dividend yield is the 7%. How about capital gain yield? Capital gain yield P3 we already know the price of at year 3. Then what is the P4? P4 is what? P3 times 1 plus G divided by I minus S, right? So P3 is the 66.54 times 1.06 divided by 13% minus growth rate. Growth rate is 6%. It's gonna be P4 equal to $70.538. So capital gain yield is 70 times 70.538 minus what is P3? P3 is 66.54 divided by 66.54. It's gonna be 6%, right? So 70.538, which is P4, minus P3 is 66.54 divided by P3, 66.54. It's gonna be 6%, which is same as dividend growth rate, 6%. Okay. So after year 3, 4 years, the dividend yield is 7%, capital gain is 6%. 6% is same as the growth rate, dividend growth rate. So if dividend grow at a constant rate, then capital gain yield equal to growth rate. But if those kind of relations doesn't work, then the capital gain yield is not equal to growth rate. Okay. Then what if the growth is negative growth? If the stock was expected to have negative growth, negative 6%, would anyone buy the stock and what is its value? So what if growth rate is negative? Then the firm still has earnings and pays dividend, even though they may be declining, they still have value, right? So if you take a look at the basic equation, P0 equal to D1 divided by RS minus G. If G is negative, then the price is $9.89. So still, the stock still has the value, but very low value, right? They still have value, even if those value is so small as of $9.89. Okay, so even if you know uh, dividend, I mean the growth is negative, dividend growth is negative, but still there's the value according to the equation for dividend discount model. All right. Any questions so far? This is the dividend discount model, constant dividend discount model. Any question? Okay. Yeah. Okay, if you don't have any question, then let's take a look at the another valuation model, corporate valuation model. Corporate valuation model, which is more realistic model to use the industry corporate valuation model. So corporate valuation model is also free cash flow. Free cash flow. Free cash flow is so important concept. Free cash flow. We say free cash flow. So as I exaggerated several times in finance, the cash flow has the more meaning than the earnings or profit. Okay, so how much money that I hold, yeah, how much money in my pocket is more important thing than the profit, accounting profit or accounting the earnings. Okay, so that suggests the value of the entire firm equals the present value of firm's free cash flow. So when we define the stock price, we already use the cash flow, right? So I already defined the stock price, the present value of future cash flows. I defined just like that one. So cash flow is so important thing. Then what is free cash flow? What is free cash flow? Remember, free cash flow is the entire firm's after-tax operating income less the net capital investment. The reason why I wrote down remember is because in the last, I mean the semester last year, we covered chapter 3, which is financial statement. So in the last semester, last year, we already deal with the free cash flow in chapter 3. But in this semester, we skipped the chapter 3. Okay, so let me explain the free cash flow in the chapter 3. So, free cash flow is very important concept. So let's take a look at the page number 82. Page number 82. Here's the definition of free cash flow. Free cash flow can be defined as the amount of cash that could be withdrawn without harming a firm's ability to operate and to produce future cash flows. Let me say again. Free cash flow is the amount of cash that could be withdrawn without harming a firm's ability to operate and to produce future cash flows. Let me repeat again. The amount of cash that could be withdrawn without harming a firm's ability to operate and to produce future cash flows. In other words, free cash flow means what? The cash, I mean the cash that we can use as of today without any limitation. That's the free cash flow. Okay, free cash flow. So free cash flow can be free cash flow is the forms after tax operating income. So this is the formula to calculate the free cash flow. So free cash flow is the forms after tax operating income less than net capital expenditure. So free cash flow can be calculated by operating cash flow minus investment in operating capital. Operating cash flow can be calculated by EBIT times 1 minus T plus depreciation and amortization. Investment in operating capital is capital expenditure plus increase the delta means increase, right? Increase the net operating working capital. Net operating working capital. So, and the EBI times 1 minus T is also named as NOPAT. NOPAT stands for net operating profit after tax. So, in NOPAT, we don't have to consider the interest. So, the EBIT minus I equal to EBT times tax is the net income, right? But NOPAT in NOPAT we don't consider the interest rate. So EBIT minus just tax directly. This is called as NOPAT, net operating profit after tax. So its time's almost up. Okay, so and this is a cash flow. So when we calculate the EBIT, we deduct the depreciation and amortization. But from the point of the cash flow, depreciation and amortization should be add back because depreciation and amortization are not associated with cash outflow, right? Even if cash is not the not outflow, but we deduct the depreciation and amortization from the earnings. So depreciation, what's the difference between depreciation and amortization? Depreciation is what? We need to deduct the value of fixed asset. For example, if we hold the building, then building has the the life, right? The period of our life. So if we use for example, computer, 10 years, the life is the period is 10 years, then we need to we need to deduct the value on every year. That is called as depreciation. 감가상각 in Korean. So depreciation is related to the tangible asset, whereas amortization is associated with intangible asset, such as patent. Okay. So generally, I'm not sure, but generally, if the drug company create a new drug, then the health authority guarantee the 10 years of patent. So after developing the new vaccine, something like that vaccine, for example, during the 10 years, the medicine company enjoy their patent. But after 10 years, other medicine company can produce the same drug with the same chemicals, right? Which is called as we would say the 복제약, right? The copy drug, right? So that kind of things is so we need to deduct the value of those kind of patent. That value of deduction is called as amortization, 감모상각, right? 감모상각. All these kind of things are like accounting. So anyway, so this kind of things should be add back because this kind of depreciation and amortization are not associated with the cash. But to calculate the EBIT, depreciation and amortization is already deducted, so we need to add back. Okay, let me stop here. Time's up. So I will explain this one in